I've been reading a couple of great books by unlikely poker players, Thinking in Bets by Annie Duke and The Biggest Bluff by Maria Konnikova. Both are trained psychologists who are interested in how we can make better decisions under uncertainty, and both had an interest in poker and how maybe learning to play poker could help them to understand that decision-making process. Well, it turns out that poker is great training ground for evaluating circumstances where you may have enough information to know the odds of success or failure, but not enough information to guarantee the outcome. To me, that sounds a lot like investing. In poker, the great players know the odds of almost any starting hand they're dealt with, and they can continue to understand how the odds change when each additional card hits the felt, as they say. But they also know that while probabilities tend to work out over hundreds of hands, any single hand is subject to a lot of luck, kind of like coin flips. Each hand is an independent hand of all the others. And so luck plays a big part in any single hand, but skill can provide great advantages to the player over many hands. Let's look at how understanding odds in this way, probability, can help make sense of maybe some election polls, which we're interested in because of elections this week, and also how they relate to investment markets. While Americans may be very split on how they hope the election turns out, one thing almost all agree on is about this election needs to be over. We want the crazy ads and the mailings to go away, and hopefully by the time you're watching this, that's the case. What do the polls indicate going into November 8th? Well, Nate Silver is a pretty famous pollster. He runs the website 538. In these two charts, he's demonstrating a model that simulates over 40,000 election runs using the polling data that was available as of October 31st. And what you can see is when he runs those simulations 40,000 times, it yields kind of a probability of result. You get so many results out of every 100 runs. If we look at what happens in the Senate, based on these probability runs that he does, well, in the Senate, 55 in 100 times, Republicans win control of the Senate. 45 in 100 Democrats do. As we'll see in a minute, it might be closer than what those numbers indicate. When you look at how things are going in the House, 84 in 100 times when they run those 40,000 simulations show the Republicans gaining control, being in the majority in the House. Here's another way to look at those probability distributions. The one on the left, again, looks at the Senate. Here we see 80% of possible modeled outcomes. The Senate in those elections shows a distribution centered around the Republicans winning 50.7 seats. Now, I don't expect we're going to see 7/10 of a person getting sworn in this coming January. That's what the model means when Nate says, hey, this is kind of a dead heat. It's really hard to tell. But in the battle for the House of Representatives, the distribution of modeled outcomes looks a little better for Republicans. But there are still 16 out of 100 instances where Democrats hold the House. That's not quite a 1 in 5 chance, but it's still a plausible outcome in terms of probability. In 2016, similar modeling done by 538 gave Donald Trump a 29% chance of winning the Electoral College. Now, Nate Silver was later excoriated for getting it wrong with his pre-election polling, but his numbers, remember, gave the former president better than a 1 in 4 chance of winning the election, which he ultimately did. As an example of how this works, let's consider LeBron James. LeBron James's lifetime free throw shooting percentage is about 75%. Is anybody really surprised when LeBron James misses a free throw? After all, he misses 1 in 4 times. Should we have been that surprised, for example, when President Trump won in 2016 with the odds that Silver was giving him? The thing is, with LeBron James, we get to see free throws shot in great big numbers. He shoots a lot of free throws, so seeing him miss once in a while is a regular occurrence. In an election that we only see the result of every 1 or 4 years, we don't get to see the number of repetitions, so those odds can seem a little more surprising. How about things like forecasting inflation and interest rates? The Fed has always used all kinds of statistical models to forecast actual inflation, and their forecasts for inflation influence what they think their interest rate setting policy is going to be years in advance. This chart we're looking at here is the Federal Reserve's dot plot. The gray dots represent what the Federal Reserve thought their interest rate would be set at in September of 2021. So you can see when you look at those gray dots, take a look at the stack there between 2022 and 2023, you can see that they expected their rate setting policy to be somewhere maybe around 1%. Well, what's actually happened is inflation came out much hotter than they thought it would just a year ago. And so their actual implied Fed funds target rate, you can see in the yellow dots above. What's actually happening with interest rates, what the Federal Reserve is actually doing in setting their policy rate, it's almost a 300% higher interest rate than they thought it was going to have to be. They're closing in on 4%. It was 3.75 the last time they raised it. Now, was this a failure on the part of the Federal Reserve? Well, their statistical models told them that inflation was a possibility, but at the time, back in 2021, it didn't seem like a high probability, and they're forecasting their rates based on those probabilities. Turned out that those probabilities underestimated the actual inflation rate as we see it today. Just how hard is inflation to predict after all? Well, this graph compares with the New York Fed's inflation forecast. The dark blue line was 12 months before the actual reading, which is the light blue line. So, for example, the March 2020 forecast for the March 2021 actual inflation rate was right on the mark at just over 2%. You can see the crossover point there, which is the circle right before the green bars start to appear on the right-hand part of the chart. However, since then, what you can see is the Federal Reserve has been underestimating what actual inflation would be, at least a year in advance. That light blue line, actual observed inflation, really began to climb very quickly. But the dark blue line, again, that's the Federal Reserve of New York's inflation expectation just 12 months earlier, was far below what actual inflation turned out to be. What does the market think inflation is going to be in the future? Well, currently the bond market thinks that the odds of inflation is back to moderating to somewhere in the mid 2%, at least over the next 5 to 10 years. This is currently the reading for the 5, 10, and 20-year projections based on these things called break-even rates, which just compares the rate of interest on a Treasury inflation-protected security, a TIP, with a nominal Treasury, which doesn't have an inflation adjustment. The difference between those two yields is basically the market's estimate of what inflation will be in the future based on the maturity of the bond, so a 5 or 10-year bond. You can see they're all centering right there around 2.5%. So what might we say when it comes to understanding the odds of success in markets coming out of the election? We've talked a little bit about what do the odds say about inflation, what do the odds say about rates, and what do the odds say about election results. In a recorded interview I did with Dan Clifton of Strategas Research in August, he talked about how normal it is in midterm election years to have some larger drawdowns in equity markets. We've certainly had that this year. In other words, this year's market performance isn't that unusual, though, of course, the supposed causes always feel unusual at the time. But if we look at the chart on the right, what should we expect, or what could we reasonably expect after this midterm election? Well, looking at past midterm election years when markets have been somewhat down, the average return after the election, at least in terms of the S&P 500 stock market index, have been fairly strong positive returns for investors who were invested post-midterm election. Also, when we think about election results, some people think, well, is one party going to be better for the market than the other? We update this chart every 2 years. We update it again through 2021. And here what we see is investment markets are basically nonpartisan. Regardless of who has control of the executive branch or either house of Congress, what we see here is over time, pretty good returns on average for investors, regardless of the regime in Washington, D.C. The average return, again, the S&P 500 over this time frame was about 12.3%. And what you can see on the chart there is pretty much all those rates represent something in and around that 12% rate. What we like to caution investors when they think about the results of an election, and you're probably thinking about the results of an election as you're watching this, is while it may seem very important as to who won or lost, from the market's perspective, it's relatively not important. Meaning corporations, they want to know what the rules are. They're looking to an administration and a Congress to set those rules. Those corporations will then make policies to try to be profitable under whatever market conditions they're facing. And in the past, they've been pretty successful regardless of who tends to control the office.